We start off with the big breakdown on Wall Street. The Dow crashing below the 30,000 mark for the first time since January 2021. The Nasdaq dropping more than 4%. Its second decline of that size in just 4 days. The biggest of big tech getting smacked. Apple, Microsoft, Alphabet, Amazon, and Meta losing a combined $250 billion in market cap just today. But the pain was widespread. A whopping 215 stocks in the S&P hit 52-week lows today. That is more than 40% of the index. So what does this all tell you, Guy?
Well, it's interesting. For a long time now, I've said the only panic I've seen for the last couple months, Mel, has been on the upside, days where the market goes higher, and the down days have been pretty orderly. Today, for the first time, in my opinion, in a while, it felt a little panicky to me, which I happen to think is a good thing. Now, full disclosure, as you know, 24 hours ago, we sat on this desk and I said I thought the market would have a violent rally. That clearly didn't come to fruition, although I do think that's coming to a theater near you. So stand tuned, people. But I'll say this as well. This market is doing everything we thought it would do the months leading up to this. Valuations are coming down. The market's readjusting to a Federal Reserve that finally seems to be getting some discipline around it, and I happen to think that's a good thing as well.
Right, and as you've been pointing out for months and months, the volatility in the Treasury market has been really out of control here, and there was times, Guy, where I honestly would say, well, it's not that, it is liquid and this and that, but the volatility that we saw today from 3.2 to almost 3.5 back to 3.2, you've also been saying that, hey, listen, people, the idea of yields coming in is not exactly at this point in the cycle a great thing for equity valuations. I think that's really true when you think about just what happened and what got hit today. The names that were down 50, 60, 70% were all down for the most part, at least the stuff that I'm looking at least 5%. And then you had those large cap names, especially in tech that you were just talking about, Mel, were also getting absolutely bludgeoned. And then throw in some areas that have actually been strong over the last few months. Energy, OIH, XLE, the ETFs that track, large integrateds and the oil services down a lot. And, listen, again, staples, utilities. It seems like, correlations are going to one here, and that might speak a little bit to what Guy is talking about, panicky to the downside.
Yeah, I agree with both those guys are saying. I think that it did start to feel panicky with the VIX, which we talk about a lot. We'll get to that a little bit more later, but that was elevated today for sure. Sort of interesting. Again, we come to cross currents, right? We're fighting inflation. Oil, or at least oil equities coming down. Oil itself, not a huge move. Actually, I ended up the day a little bit. But so there's sort of a disconnect there. That divergence between the underlying and the energy equities is pretty interesting. I mean, Dan called that, I think, last week, saying it doesn't really matter what oil does. These equities are going down. That was an excellent call. So that's sort of interesting. And then fears of inflation, yet the 10-year today.
Coming down.
So a lot of cross currents. I do think that correlation to one, when things really, go to hell in a handbasket, everything correlates to one. It's kind of where we are. Very, very painful for me. I'm always long. So the hedges work some, which is nice. The longs go down. I'm much more long, which is not nice. But, I think there's still more to go. So I'm not out there buying quite yet, except a little S&P.
BK, what's your take on all of this today? And I'm wondering if you think the markets are signaling that they think that a policy error is in store. The notion that the Fed is on the way to a recession or a stagflationary sort of scenario, and that's why we are seeing the 10-year yield come in.
Yeah, I think the markets have been saying that it's been a policy error since November. That's where the high was, and that's when we started selling off, and everybody thought, okay, the Fed's behind the curve. Now they're so far behind the curve, and now what they're doing, and it's exactly what they wanted, so be careful what you wish for. They wanted the economy to stall, get slower, so prices came down, labor supply increased. That's what they wanted to see, so they're seeing it. It's awfully painful, but I think if you look at the price action in bonds today, to me, that was one of the most interesting things. Yields going down and the stock market going down. So now I've got a scenario where yields go down, stocks go down. Yields go up, stocks go down. That's just not a great scenario for stocks. I'm not a mathematician, but 2 out of 2 is bad.
No, you're not, but you're a handsome mathematician if you were. But I'll say this. I can try to logically explain in my mind why yields went down today, and this is something we've talked about for a while. I don't think yields going down spurred the stock market. I think it's this flight to quality as the stock market was getting bludgeoned finally in the form of 10-year yields, which makes sense intuitively. But If you think yields going down are bullish, which I don't think anybody is suggesting, it's actually more bearish. And BK makes a good point. We have now found ourselves in an environment where yields going down is bad and yields potentially exploding to the upside is bad. And that's what's been created. And just my last word on the subject. The policy error by the Fed is not being made over the last couple of months. The policy error was made years, if not decades ago. Just my opinion. I'm not speaking for the rest of the guys and gals on this desk, but that's where I come down on this whole thing.
Yeah, and I'll just say the price action. I was down on the desk last night. I was watching. You guys did a very nice job. I mean, listen, it was about as confusing of a market. You just used the term cross currents, Karen. When you think about it, I mean, I've been in the business for 25 years here, and I can't remember a time where there's so many different macro factors that don't line up. Oftentimes we'll look to say, well, if this happens, then that might happen, and then this makes sense to do that. And I thought the knee-jerk reaction, I know a lot of people were set up playing for a rally out of the Fed. They thought that 75 basis point hike was very well telegraphed, albeit in a very short period of time before it. And I think that sort of level of uncertainty, the fact that it really showed the Fed's hand, just like all of us, how confused we are about what's going on right now. I think the Fed is also, and I don't think the things that they're trying to battle right now are that controllable. And the last one, this is my daily reminder here today, is that, you know, all of this, they're trying to actually loosen up the employment market a little bit. That actually will add to some of the problems that we're feeling right now on the economic front. So your question about a 3.2% 10-year U.S. Treasury yield, if you think the front end is the one that the Fed is trying to influence with Fed funds, it's the 10-year the one that reflecting the sort of growth. And if we do see unemployment tick up from basically pre-pandemic lows at 3.6%, if we get anywhere near 4%, the economy is most definitely going to be in a somewhat protracted recession. And that stagflationary environment is the one where investors will have a hard time pricing risk assets like equities.
Well, it seems like I mean, not speaking for the market, but it seems like right now the scenarios of recession, the odds of recession are climbing. The odds of a potential stagflationary environment are climbing as well. And the most likely scenario is one of the two, as opposed to the scenario of sticking the landing, of just exactly threading that needle. And finally, we've come to that sort of realization.
Right. I mean, I'm not seeing a Carrie Strug, if you remember her from, I don't know, whatever Olympics that was, happening here. And, you know, we talked about this with Steve Leisman last night, the idea of if we are in a recession, I actually think that may be what the markets need, because they look forward. And I think that time and again we have seen markets bottom before the economy bottoms. And if the economy is just, you know, sort of flailing around, that's, as you said, the stagflation scenario. That is not the good. That's the bad case.
Can I just get in here real quickly, though?
Please.
Again, the S&P closed down 23% on the year from an all-time high. And if you think back to 2018, we did not have the inflationary pressures. We really did have growth concerns back then. Maybe there's some valuation concerns. And so my point is that if the market bottomed down 20% and we're down 23% right here, that's not happening. And I go back to what you were just saying about, you know, the last time we had a recession after a huge asset bubble, obviously the financial crisis, but go back to the dot-com 21 or 2 years ago. I mean, at the end of the day, that was a protracted bear market led by, you know, we were worried about double-digit recession. So I don't think there's one point in time that you're going to be able to point to in 2022 and say this is done. I think we're in it for a bit of a long slog
That may
here.
be, but we talk about the market as a monolith, which it's not, right? So we've seen these rolling, you know, sort of corrections and then crashes. I mean, I still think actually on some of the super high flyers, we still have some ways to go. But there are other things that I think are excessively punished in that same correlation to one washout scenario that I think could do okay. If you look at the internet bubble when that burst, a lot of companies bottomed right then. The tech.
In 2000?
2001, 2000, around there.
Not really. 2002 was the worst possible year. And I say this all the time. For stocks that were down 50, 60%, they got cut in half, they got cut in half again.
Right. But if you look at some of the value stuff that was completely left for dead during the 99-2000 run-up that nobody wanted to touch.
But there were no values this time. The only values were energy, and they just like blew out and then just came in 10, 15%.
So may I insert myself in this conversation?
Please, it's your show.
I think that it's interesting that everybody tries to find a corollary, right, in history. It was like this time. It was like that time. This time, and I hate to say it's very different, but the circumstances going into this period of time are, in fact, very different, Brian Kelly. And if you take a look at trading floors across Wall Street, you know, any of the firms here, how many people were trading this market or conscious to the point of knowing how markets reacted in 1994 to a 75 basis point hike. The fact of the matter is not many people have that experience with that, let alone the circumstances that we are in right now.
Absolutely. Well, right. That's exactly right. And I've spent the better part of the last month reading about markets from the 1930s and 1920s, because those are the scenarios that look a lot more analogistic to me, or whatever that word is. But that's what it seems to me, is that we have a scenario where you've had an everything bubble. You've had the most monetary stimulus in the history of the world. You've had every single asset class, including my beloved Bitcoin, be blown to the moon. Why wouldn't it take a long period of time to work off that excess? To me, that's the baseline scenario that you have to be with. And I think probably the only person who could remember all the way back to the 20s and 30s is Guy.
Can I just talk about one corollary interesting to the 1930s was the bringing everything back to the United States. We are actually now, there is a corollary there of the onshoring and de-globalization.
Yeah.
Well, I do actually remember that. It was fun. You know, it was difficult to go through, but in retrospect, some of the best years of my life. We learned how to be together as a family and all those things you read about in your books. Why is it different this time? I'll tell you exactly why. Because now you have central banks globally hiking into an environment where global debt to GDP, as BK will tell you, is probably approaching 125% or so, which is ridiculous, unsustainable. Here in the United States, close to 100. Higher, right, higher, Bob, higher if you're playing Price is Right. So, I mean, it's insanity 300%. If you really think about it, and that's why it's different, Melms.
300%. Wow. So it's an everything bubble, BK.
Yeah,
that has to work itself through globally.
That's what I think. I think that is the scenario that has the highest probability, as we just discussed.
Yeah, and I would just say here, so how do we kind of find bottoms? We need sentiment to shoot the other way. We had, multiple years of just, you just called it the everything bubble. I think that was a term that a strategist who was very bullish on a lot of things and very right for a long time, until you see people like that capitulate on that sort of thing. And, if you look at, I saw a report from FactSet earlier today about the number of buy ratings still on S&P 500 stocks that have been corrected 30-40% or so. You can't just ride those things out all the way down 50%. At some point, you're going to have to adjust your ratings and your estimates and that sort of thing. So I think sentiment is really important, but we say this all the time. Mel, you just said it's different this time. I traded through the late 90s and the 2000 bust afterwards and into the financial crisis and afterwards, and we all have a lot of scar tissue from that. I will tell you that there's a lot of components of both of those lead-ups and blow-ups in what's going on right here. And I will tell you again, if you're watching this show and you did trade through those periods, you will understand that what's going on right now is very different because of the inflationary environment. Back in 2000, it was really easy to lower interest rates. Back in 2007 and 8, it was easy to lower interest rates. They can't do that right now. And that's why I think you're going to have all of this volatility, and why 23% lower in the S&P and 31% lower in the NASDAQ will not cut it this time, people.
So where do you think we go?
Oh, I think we round trip back in the S&P 500 easily to the pre-pandemic highs, which was about 33.93 or so. And then if you look at the NASDAQ, it probably round trips that, and that's down 40%. So the S&P is going to be down 30%. All that being said, depending upon what your time horizon is, if you were one of these people who has excess investable capital, you have to start thinking about dollar cost averaging in really good stories or sectors where you think valuations have overshot to the downside. And some of these most innovative sort of names that just were trading at disconnected levels of price to sales 30, 40 times or whatever, once they come into single digits, they're like a hat size. That's when you may say, okay, if I have a 4 or 5 year time horizon, that's where you start picking.